Welcome guys to our very first video, Accounting 101. So today I'm going to be teaching you about accounting equation. A lot of people struggle with this topic, so I've decided to, start this YouTube channel so that I can help you guys. Accounting equation. So basically, today I'm going to show you something that that will make you never forget accounting equation. So just sit still. So accounting equation basically is the same as financial position, and financial position is the same as the balance sheet, because a balance sheet is made up of your assets, your equities, and liabilities, right? So I don't want to jump and then already give you examples of what these are. Before we get into the accounting equation part, you need to know these items. You need to know what are assets. You need to know what is equity. You need to know what is liabilities. If you know these things, you will automatically know accounting equation. So before we jump into the into your accounting equation, today I want us to focus on these things. I want us to focus on assets. I want us to focus on equities. Excuse me. I want us to focus on liabilities. If you can master these things, you'll automatically know your accounting equation, because you will know where to plug in why. Because you will get a transaction. For every transaction that you get in accounting, it will either fall into these big three. I know there's also income statement. I'll tell you how these things link up together. But basically, all your income statement, they will come and sit here on your equity. That is why I'm saying all your accounting equation, all your accounting transactions, basically they will be sitting here on this equation. As time goes on, I'll show you how your income statement transactions will then fit into equity. But for now, I really want us to know what are assets and what are equities and what are liabilities. This is very important. You need to know these things off by your head. But I don't expect you to know them today. What I'll give you today, I'll give you a guidance that will help you to know these things. But if you really want to master it, maybe after some time, you really need to either you memorize these things, do more examples, do more practice examples of what these things are, right? Now, like I said, we need to define what are assets. We need to know what are equities. We need to know what are liabilities, because that's where everything is going to fit in. I'm going to give you a definition of an asset. Don't worry about the big definition here. It's a resource. I'll break it down to you, because this is the key in knowing what these things are. If you can know these things and you know how to identify them, you will do your accounting equation even in your sleep. Just follow me, I will guide you. We said assets is equals to equity and liabilities, right? But before we get to the accounting equation, we first need to define what assets are. I know everyone has got his own definition of an asset, but not all the assets that you've heard that you think are assets are actual assets. Today I'm going to give you the correct definition of what an asset is, and you'll be able to tell a person if he comes and any claims that this is an asset and it is not. So let's look at this. Is according to IFRS. Now IFRS is basically it's an accounting body. So there's this organization that sets standards for accounting. It's an international financial reporting standards. So It's acceptable everywhere. You go to Australia, they're using IFRS. You go to any other country, they use IFRS, you know. So then this is what is acceptable. These are the standards that are acceptable. I know America, they use GAAP, but other than America, most companies, they use IFRS. So if you know IFRS, you are able to pretty much work everywhere. Most countries are using IFRS. I'm talking Australia, most countries in Europe, and obviously South Africa and the rest. Now, let's look at the asset. What is an asset? You know, according to IFRS, an asset is a resource controlled by the entity. I really want you to note these things. For anything to be an asset, it has to meet everything that is written here. If one of them is missing, it's not an asset. It says it's a resource controlled by the entity as a result of the past event and from which future economic benefits are expected to flow to the entity. So the first thing that is for you to be able to identify whether it's an asset, it has to be a resource and it has to be controlled by the entity. What do I mean by resource? What do I mean controlled? Resource means it is producing something. It's producing something. It's like if you have a machine, you're using that machine to dig up gold. That machine already it's meeting at the partly we're gonna continue. We haven't really fully looked at the description of an asset, but because it says it's a resource, it has to be producing something, right? That's the first thing. It has to be basically what it really produces. It boils down to money, but we'll get to that. But it has to produce something. If you have something that is lying down there that is not producing any, but it does not necessarily have to be literally a machine. You can have money in the bank that is generating you interest. That is an asset, right? Because it's generating you interest, so it is a resource, it's producing more. It's able to multiply, right? The second requirement, it has to be controlled by the entity, right? It has to be controlled by an entity. If, for instance, you are in a company and you have this machine, it's producing all of sorts of income for you, but that asset is not yours. Maybe you borrowed it from someone else. Unfortunately, you cannot classify that as an asset in your books. It's not an asset. It's got its own classification. We'll get to that, but it has already failed the definition of an asset. It has to be controlled by the entity, right? Number three, the asset, it has to be also be coming from the past events. So what this basically means, it means this thing that you have here, there must have been a past transaction that took place. It's either you went and you bought it. Basically, when it says as a result of the past event, it's referring to you when you were actually going to buy it, right? There must have been a past event that you now have this asset, right? And another condition, there must be some future economic benefits that are expected to flow into the entity. In other words, you must be expecting some cash in the future. For instance, like I made an example with the asset that's producing whatever you're digging gold with that machine, right? It's producing assets, and also you're expecting to get money out of this asset. So if it's sitting there, there's no way you're gonna get money out of it. It's not an asset, unfortunately. If your parents they borrow you they go and then they borrow you a car, is that an asset or not an asset? Let's first go back to our definition. Is it a resource? Is it producing something, that car? Are you controlling it? Is it under your control, or your parents can call it up any day and say, bring that car back here, right? So those questions need to be answered before it can be an asset. Has there been any events happened? Yes, the event, yes, your parents gave it to you, blah, 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 right? Are there any future economic benefits that are you expecting to get from that car? No, you're not going to get anything. Probably your parents will, but you will not, right? So these are the conditions that you need to meet before you can classify it as an asset. So as we are going to be doing an accounting equation, we're going to be looking at different transactions, and then we need to check where the transaction falls into, right? Now let's look at liabilities. Liabilities are basically an opposite of assets. Here it's stuff that we own and we control it. And obviously it's a result of the past events. We probably went and then we bought it and we're expecting to get money from it, either through when you're selling that machine, or this machine is still producing and then we're expecting it to still run for the next 5 years. Or let me just make you an example with a very common asset like maybe a truck. Most trucks do meet a definition of an asset because, okay, the trucks that are owned by the entity, you're using this truck to load cargo and then you're taking it from here, you're taking it to Durban, Cape Town, wherever, all right? It's being used to produce future economic benefits. And this truck still has value. Even when you sell it, you'll still get money out of it. But what if this truck, you've been using it for whatever years? Let's say you've been using it for 10 years. And when you try to get a buyer, they literally say, no, we can't buy this, right? So you see that it doesn't really meet a definition of an asset because you can't really get anything from that asset now, from that truck. So the value is literally nil. You're not going to get anything. But we'll get to that. So that's where now the value is being written off and so on. We'll get to that. But for now, I want you to grasp the definition of an asset. And then we're moving on to liabilities. Liabilities, I just said it's an opposite of an asset. Let's look at the definition. A present obligation of the entity arising from the past event, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefit, right? Again, for it to be an obligation, I mean, for it to be a liability, it has to meet each and every one of these. You must have a present obligation. You must be owing someone right now. It's an obligation you are forced. Either there's a contract or whatever installment or whatever. You went and then you bought this truck from the bank. You're still owing your bank 1.5 million. It's a present obligation. It's in the name of the entity, right? Obviously, it's coming from the past event. That's when we went into the bank and then you asked for finance, and then the bank said, okay, we will lend you money. That's a past event. And those are the events that happened in the past. If the event is going to take place in the future, that this part is not met, so it cannot be a liability. For instance, if you're saying, okay, we maybe next month we're going to be signing up the contract with Standard Bank, they are financing us with 5 trucks, for instance. You can't classify that as an obligation. The event has not taken place, so it doesn't meet the definition of a liability, right? And the settlement of which is expected to result in an outflow. Do you see the difference? Here it's an outflow. You're expecting that money will go out of the company. That's what it means. There's going to be an outflow of cash when you're settling it because it's a liability. from the entity resources. Basically, it's gonna come out of your resources, embodying economic benefit, right? So you need to know this. Have these conditions somewhere close by, and because for every transaction, either it's an asset or liability, you have to come and test through this definition, right? Now we have looked at assets, we have looked at liabilities, right? I'm coming to the examples. We've looked at these two. Now we need to look at equity. Okay, you also need to know income and expenses. Let's look at equity. Okay, they didn't really define equity here, but equity is basically all the contributions that the shareholders make into the company. So for instance, if you start a company and then you put in a deposit, you say, okay, I'm starting a company and I want to maybe contribute like 100,000, right? That contribution forms part of your equity. This is what you contributed into the company, right? But that's not all. Equity is not just your capital, right? Now, if the company, let's say you're starting the company with your 100,000, you start transactions, you go and then you make businesses and then you start making profit, right? Let's say in your first year you went and then you made profit of 1 million, right? That profit, it increases your equity because it's still your money, technically. Whatever that you started in the beginning with 100,000, it has literally now grown. Now you have like 1 million rand. So basically, all your profits, it comes to your equity. So it's your income less your expenses. The net of these two, they will go to your equity. If you guys don't understand this part, please let me know what goes into equity. It's three things. Equity, obviously, it's your share capital. That's money that you started your company with. Secondly, your net profits. There's other things that goes in here, but the large part of it is going to be your net profit, right? So you started with 100,000 rand and you made 1 million profit at the end of the year. So your equity now is, you've got 1.1, right? Okay, we have looked at assets, we have looked at liabilities, we have looked at equity. Now I want us to move on to income and expenses. Remember, this will all filter or fill into your accounting equation. Assets equals to equity and liabilities. And remember, I said your equity is where your income and your expenses will go to eventually. So what will form part of your equity would be obviously your share capital plus net profit. And we already know that the net profit is the net of income and your expenses. Because you started your company with 100,000 rand. After a year later, you made a profit of 1 million. So now you're sitting at 1.1 million in the total equity. So now I want us to look at the income and expenses, right? Again, you need to look at these definitions before, but if you know the definition of your assets and your liabilities, it's going to be easy to then pick or to tell whether it's an income and expense. Because if it doesn't either fall on your income, I mean on your liabilities or assets or equity, then the only thing that is left is these two. Now let's look at income. Income increases in economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases of liabilities that results in assets that results in increases in equity other than those relating to contributions from equity. Okay. What basically this thing is saying, it says your income, it increases your economic benefit. It's like sales. As sales, for instance, if you run a business and then you're selling something, maybe you're selling whatever, I don't know, tables, for instance. And then as the more you sell those, that's your income. You know, as people are coming in, they are paying in money, and then that's your income. And another important thing that it has to happen during the accounting period, right? In a form of inflow. Obviously, people are paying you, and then money is going in, or enhancements of asset. Uh, so in other words, these are other things that would form part of income. Basically, what enhancement of asset means, sometimes assets they get revalued. So if an asset gets revalued and then you find that okay, the value of an asset is actually more than what it is, then that would go into your income, right? Because accounting uses double entry system. So you would have two legs. For every entry, there's two legs, right? I mean, for every accounting entry. So if, for instance, an asset is enhanced, let's say you bought an asset for 1 million rand. This is when you were buying it, 1 million rand. You bought it cash. Let me just do this. You bought assets for 1 million rand, then this is bank, right? So your assets are sitting on 1 million rand. Let's say you bought property. Let's say this was property. You're using this property as an investment property. You've got companies that are renting from your premises. It's a office space, right? Let's say you bought this in 2001. Let's just make an example with 2001. Now, every year, especially in investment property, every year the assets needs to be revalued. You know that the value of an asset generally goes up, especially property. Let's say now we come to 2023. When you then decide to revalue your asset and then you find out, oh no, this asset now is worth more than 3 million. So again, you must just remember that there will always be two entries in accounting. In accounting, basically, there's always, if you have a debit, there must always be a credit. Otherwise, you'll never balance. I'm trying to come to this point, to explain to you how then there would be income in how would assets affect your income, which goes into your income statement. So when they revalue your asset and then you find that now it's sitting on 3 million, what you're gonna do, you're going to debit your asset, credit your fair value, but then this would go to your income statement. So now it's 2 million. Okay, now this is a credit, and this is another 2 million. Your assets will then now, because this 2 million is going to get added with this, then now you have 3 million. So that's how it affects your income. That's how your assets affect your income, because this goes to your income statement. Okay, obviously this is balance sheet or the statement of financial position, but I'll just call it balance sheet for simplicity. So this is what this thing is saying. If your assets gets enhanced, it will go to your income statement and then it's going to increase your income. So this would be an income account. Or decreases in liabilities. And then again, how will your decrease in liabilities affect your income? That results in increase in equity. Sometimes you have people that you owe money. Let's say as you are selling a desk, right? You find that, oh no, some of these desks are it's broken. A couple of them, it's high value. So now, obviously, you'll take those stuff back to the supplier and that will decrease your whatever that you owe those people now. This is what basically this is saying. It's going to decrease your liabilities, and and then eventually then that would increase your equity, because now you'd have more money. You're returning this thing to wherever you bought it from. That increases your equity. Other than those relating to contributions from equity. Okay, obviously other than your share capital and all that. Then let's move on to expenses. Basically, your expenses are a direct opposite of your income. It's a decrease. You're losing out money here during the accounting period. It has to be in the accounting period in the form of outflows. Money going out, depletion of assets. So depletion of asset, this would be an opposite of this. Because sometimes an asset can be written down. You buy an asset for 1 million again in 2023. Okay, let's assume that this, okay, this might be a bad example now. Obviously, don't look at this basically. Let's say in 2023 we realize that, oh no, this asset has actually lost value. So again, you'll come, like I said, you'll have debit and a credit, but now your asset will be on the credit side because it's losing value. The depletion of asset happens in various way. You can have depreciation, but yeah, with the investment property, it's really hard. It's rare that you have your investment property going down in value, but it does happen, but it's very rare. So let's just assume that this wasn't an investment property. Let's use another class of asset. Let's say you bought a truck. You use this truck to deliver your goods and all that. You bought it for 2.5 million. 2.5. So you've got an asset. You bought this truck cash a while back. Again, it was in 2000 and let's say you bought it recently. Let's say it was 2019. And now we are in 2023. Because every year, assets like trucks, for instance, they lose value every year. Normally, you write it over maybe 5 years, depending on what your company policy say. But let's say you write it over 5 years. So every year, your truck will be losing out value, right? But we call this assets accumulated depreciation on asset. So this would be truck, right? So this goes into your income statement. It's an expense. So now it talks to this depletion of assets. Then this goes to your balance sheet. The other leg goes to your balance sheet. So when we're doing financial statement, this amount will then be net off against this amount. So as you can see, this one is on the debit, this one is on the credit. So when you map these together, one is on the debit, the other one is on the credit, you will see that you'll be left with 2 million. The asset has now gone down to 2 million because this is going to be minus this because they get to be mapped together. So now your actual value of the truck is 2 million, but we call it a carrying amount. We're calling it a carrying amount. So your carrying amount now is 2 million. So what I'm trying to say to you, the depreciation of assets goes to your income, I mean to your expenses, of which is under income statement, and also in occurrence of liability that results in decrease in equity, other than those that are relating to distribution of equity. Okay, right. Now, I know obviously you getting these definitions, you haven't really looked at your accounting equation from this point of view of knowing accounting equation. Just familiarize yourself with these definitions, and then every time when you get an accounting equation, remember these definitions, right? Now that we know the definitions, I want to show you how these items behave. You got assets, you got liabilities, you got equity, you got income, and you got expenses, right? So I'm going to delete all of this. I just, because this is going to be very critical in knowing your accounting equation. Then you got your expenses. So these are the 5 main things that play a role in your accounting equation. We've defined your assets, we've defined your liabilities, we've defined your equity and your income and your expenses. So now I want you to learn this thing. Your assets, they increase on the debit side. So in other words, if you go and buy an asset, obviously you have determined that by looking at the definition, you've looked at the transaction, okay, now you've concluded that, okay, this definition, I mean, this transaction is an asset. That transaction, you record it on the debit side because they increase on the debit side. Every time when assets go up, they increase on the debit side, right? Then let's say, for instance, you went on and then you bought another asset. This time you bought a property for 5 million. Where are you gonna put that? Debit side. Every time when you increase an asset, you always put it on the debit side. It's so simple actually. It's just that you guys haven't really probably looked at this way. Every time when your asset increase, they always come onto the debit side. Every time when you go buy or anything that is going to enhance your asset, even when you start and then maybe you revalue your asset as we're doing here, you've seen the revaluation, you see where it went. It went on the debit side. So if you come and then again you revalue your asset every time when your assets are going up. Uh, let's say you're now revaluing it for like $1 million. There you go. But what happens if we sell the assets? Because we can't always have assets or that will keep on increasing. People buy and sell. It's a business world. So people buy and sell, buy assets, they sell assets. So when you sell asset, you can guess already where it goes to because they are now decreasing. Guess where they're going now? They go on the credit every time. Let's say you sold this asset for 100,000 now. There you go. Every time when you sell, let's say you decided to sell one more time. You sold another one for 250. Oh, sorry, not that 250. That might be a little bit too small. But it can happen that you can sell it for that much. Your accounting is done. Know this rule. I'm gonna write this here. Assets increase on the debit side and decrease on the credit side. Remember this rule. And let's look at the liabilities. Liabilities are the opposites of assets. So if assets increase on the credit side, guess where the liabilities increase? If they're an opposite. You guessed it, on the credit side. They behave differently, just it's an opposite of their behavior, it's an opposite of assets. So every time you go and get finance, someone goes and finance you, you buy a truck, it's going to increase here. You buy a truck for 1,500,000, your liabilities increase here. You go buy more stock on credit, you've got a good relationship with the supplier, they say, okay, no man, we can give you this stock for 500,000 in credit. It's going to increase on credit. The plus just reflects the increase. They give you a stock for 500. You owe these people 500,000 now. Guess what happens when you then start paying off these people? You could have guessed it easily. It's going to come in here. When you start paying off these people, maybe they give you installments, you start paying them off, they decrease on the debit. That's the behavior of assets. They said, no man, you can pay us 100,000 a month. Every time when you go pay them, you would always put it on a credit. That's about it with assets and liabilities. That's about it. Guess what? I'm going to put this comment here as well. Okay. We're now going to look at equity. Okay. Now you've seen how assets behave in relations to compared to equities. I mean, compared to liabilities. Your equity behave exactly the same as liabilities. You may ask yourself, why do they behave like liabilities? Because liabilities is people that we owe, but then equity, remember we said equity is whatever that the owner has contributed and the profits in the past. But in accounting, whatever that the owner contributes in accounting, it's treated separately. It doesn't belong to the company. So if you start a company and you put in money like 100,000, that money goes to equity, of which will look like the company owes someone money. So we don't treat it as part of the asset. If you put in money in the company, for accounting purposes, that money will show as equity. It doesn't belong to the company. What really belongs to the company, it's all its asset that it has bought with its own money. So if the owner, for instance, decides to contribute even more money into the business, that money will go to equity. Let's say, for instance, the owner realized that, oh no, the company needs more money and we need to contribute even more. That money will come in here. Then this time it decides to contribute 1.5. Okay, maybe 1,500. It's a bit small. It can be fine if your company is small. But basically what I'm trying to say to you is that the equity, they behave exactly like liabilities. Sometimes you find that, oh, another thing that goes in here is your profits. Like for instance, this, you remember we said your profits, they go to your equity. Every time when your profits go up, your equity is going up. So that million will come in here. But what happens if the company makes loss? You can guess already. It's going to come on the negatives on the debit side. If they start making losses or they've never made any profit, they will keep on accumulating on your debit side. Okay, I just want to create space so that it's going to be easy for you to understand and see. As long as they continue making losses, it's going to come on the debit side. If in the next year, for instance, they make a loss of 100,000, it's going to come in here. Let's just say loss. And here let's say capital. Profits. If they make profits, it comes in here. Profits. Sometimes the owners, they withdraw money from the company. So let's say I started off the company with 100,000. I made an additional 1.5 million, and now I feel like, okay, the company is making good profits. Sometimes the owners do withdraw money. We call it drawings. Let's say, assuming for instance it decides to withdraw 400,000, so your equity is going to lose 400,000. It's going to come in here. Call it drawings. Okay. Okay, this was profits also. Was it profit? I don't know what example we gave here. That's just equity. But remember, these profits, it's basically a total of what happened here. It's a sum. So here you basically take the net of whatever happened here. We've already discussed about your revenue, your income and your expenses. Your income and expenses, your income behaves exactly like your liabilities. It's just that they sit on your income statement. They are not in your balance sheet. They sit on your income statement, but your income, they behave exactly like liabilities, and your expenses, obviously, they're in opposite of income, so they'll behave in the opposite direction. So if they behave like liabilities, so they increase on the debit side. Okay, I think you understand the logic now. Basically, they increase here. Every time you make a sale, they will increase here. Let's say you're selling big machines or you're selling big trucks. Every time when you make a sale, they come here. Sorry about that. Okay, you probably you get the logic now. And what happens when you, for instance, you decide, or maybe your customers, they return some of the trucks. We said we're selling trucks, right? Let's say we sold this one for 3 million. Let's say then some of your customers, they say, okay, no man, we don't want to buy your truck. So then let's say the transactions happened almost immediately when the truck was like still new, and your customers are saying no, the truck was whatever reason they give you. So then come to your debit side because they reduces your sales or your revenue. And then expenses, it's an opposite of your income. So they behave in such a way that they increase on the debit side and then they decrease here. So your expenses, like we gave an example, you could have depreciation. It's all your expenses basically that you're gonna write off in the current year. You bought stationery, you need stationery. You bought stationery, let's say you bought stationery, you bought a whole pile of rims. Every time when you're buying more, you're getting more expenses. They increase here. You bought stationery, you went and you got accounting fees. You hired an accountant. Your expenses are going up. Accountant, they charge you whatever, I don't know. Then you also have, we've discussed stationery. Oh, cleaning. You got cleaning guys here. Every time, basically, every time when your expenses increase, they increase on the debit side. I don't know. Pest control, cleaning, let's say 2,500. I don't know. You can basically make any example with this amount, but the transaction will tell you how much the transaction was. You get the logic. Again, if you decide that okay, maybe you are this time you are the one who are returning stuff, you are maybe the cleaning products that you got, they are not of good value. You decide to return them, so they decrease here on the credit side. So you return them for 5,000. There's a whole lot of examples, but you will see as we move along. So we said maybe this could be returns, but it could be anything. Sometimes you do adjustments. Maybe you made an error here. Then, if for instance you're correcting this amount, obviously, let's say you recorded 15,000 instead of 10, you can just come and put it here. Maybe that 5,000. Maybe you're trying to reduce that 15,000. So the 5,000 would then come here. So this time would be an adjustment or a correction. So you understand the logic. Okay, let's recap quickly. Just gonna quickly run through this. Accounting equation, well, we said accounting equation basically it's a balance sheet or a statement of financial position. Assets equals to equity plus liabilities. We said asset is stuff that you own, you control, you have control over them, and you're gonna get money in the future for them. Equity is stuff that the owner owns. Maybe he contributed money and then also the profit that he has made so far and so on. Liabilities, we said it's stuff that now you owe people. It's money that is gonna flow out of the company in the future. Can happen in the next month, in the next financial year or wherever, but there is a present obligation where you are owing someone. And then we said assets increases on the debit side and it decreases on the credit side. Every time when you're buying more asset, you would record that on the debit side. Every time when you are reducing your asset, you reduce that on the credit side. Liabilities, they behave in the reverse direction with asset. They increase on the credit side. So every time when you go and borrow money, you record that on the credit side of your account every time, and then the additional one as well you record on the credit side. When you start paying off those people, obviously you will have to record that on the opposite direction, which is the debit side. Equity, we said it behaves exactly like liabilities. They increase on the credit side and they decrease on the debit side. Income, again, they behave like equities and liabilities as well. They increase on the credit side, they decrease on the debit side. This is when you are making sales. Every time you're making a sale, they keep on increasing and increasing on the debit side. When your customers are returning goods, you then record it on the debit side to reduce your sales. Expenses, they behave in an opposite direction to your expenses, to your income. They increase on the debit side and they decrease on the credit side. So that's about it for now. This should be easy enough. We're just gonna, on our next exercise, we're gonna jump into our examples now. We're gonna try to look at the examples and then, yeah. Okay, guys, let's now look at the examples. Like I said, I've got an old tutorial letter here. If any one of you have got a most recent tutorial letter, please do share with me so that I can work on the most recent one. But these examples are still relevant. So let's look at the first one. Mr. Bingoles Chole, a qualified electrician, started a small service business, BS Electrical, on 1 January 2006. He decided to deposit 40,000 into the entity's bank account to start a business. Remember that accounting uses double entry system. For every debit, you'll always have a credit because you have to account for what happened. If, for instance, you're saying you received money, you need to also indicate where you got it from. Then the accounting is complete because the purpose of accounting is to record and you know we really want the whole story. You can't say, okay, I've got 1 million and then no one really knows where it's coming from. No, you received money, it must be coming from somewhere. So that's what double entry is all about. So it's the same thing with this transaction. So there has to be, for every debit, there has to be a credit. So now let's look at this transaction. A qualified electrician starts a business, a service business, on 1 January 2006. Right on the first, we're busy with cricket and now also busy uqala ibhizinisi. So nangumuntu uqala ibhizinisi ngeyi-1 and then he decided, sorry guys, I'm gonna mix Zulu and English. I hope you don't mind. Iningitshele if you only want me to just stick to English, but ngizomixa. So he decided to start a business on the 1st of January 2006. So now how are we going to record this one? He started a business with his money. I almost said money. With his money for 40,000. So this looks like equity. Remember we said if someone starts a business, that money goes to equity. So let's see. He decided to deposit 40,000 into the business account. Let's go back to our spreadsheet. So what's happening here? Equity is going up. If equity is going up, which side is going to? This one. Equity is going up by 40,000. Right? And what else is going up? Let's go back to this question. He put the money into the business's bank account. So now the business's bank account has money. It's an asset. Now the business has money in it. It was given in by the shareholder. So because it's an asset, and we know that assets go up on the debit side, so then it goes up here. You're done. What we've done here is exactly the same as what's going to come in here. So you'd come on your equity, you'd have a plus on the assets, and then you'll also have a plus on your equity. You're done. You're moving on to the next transaction. All right. You can read through the explanation here, but I've really covered a lot trying to explain to you guys what assets are and so on. You see, they've even highlighted it. It must have its own bank account and so on. Okay, let's look at the solution here. You see, assets went up, the bank, equity went up. You are done. On 1 January 2006, BS Electrical bought a tools box and tools to be used by Mr. Bistole on credit from big builders for 7,000. On 1 January, they bought a toolbox and tools to be used by Mr. Bistole on credit. Tell me, this toolbox, it looks like this is what it's going to be using in the future to generate money. And he's going to own this toolbox. It's going to be his. It's going to have full control of it. And it's going to generate him money. Because can you imagine an electrician without a tools box? Can you imagine an electrician without tools? So for me, this looks like an asset. He's going to be using these tools, this toolbox, to generate him money. So it looks like assets are going up again. Let's see by how much. 7,000. But our transaction is not complete. There has to be another leg. If we're saying our assets are going up, what's the other leg? He bought this on credit, from big builders. So now we owe someone. It looks like we owe someone. It's good we have tools, but now we owe someone now. 7,000. And where are the people that we owe money? They are on the on liabilities. And where do they increase? Remember we said they are an opposite of assets. So if assets increase on the debit side, your liabilities would increase on the credit side. Right? Can also look at the explanations also here. Let's look at the third one. Let's see how they accounted for it. Yes, assets went up, 7,000. Liabilities went up. Yes, we owe someone money now. You see, creditor. These are the people we owe. These are the stuff that we own. If you have any questions, please remember to ask me. On 1 January 2006, he was busy on the 1st of January. On 1 January 2006, BS Electrical bought a ladder from Ladders Pty Ltd and paid it by check 1,200. He bought a ladder. This is a ladder that he's gonna be using to climb up whatever, maybe the roof or whatever, and then it's gonna generate him income. And normally a ladder, you're not gonna use it for just 1 year or then it's done with it. You're gonna use it for a couple of years. And he owns it, and there's value to it that is attached. To me, this also looks like an asset, this ladder, for 1,200. So if it's an asset, we're buying more assets, so assets are going up 1,200. They always go up on the debit side. Let's read the story to get the full story. But he paid it by check. Check is as good as cash. You don't owe anyone. You go, you sign a check. I don't know if you guys, I don't know if you've seen a check, but a check is basically like is as good as cash. So in the older days, people used to have checks. It's a checkbook. A checkbook would have your account number and so on, everything basically your detail. So when you write someone a check, let's say, so it's sort of like a form. I'm gonna try to find a picture and then send you a check. It's a form. The only thing you complete maybe the name of the person that you are paying, and then the amount that okay, I'm paying this person maybe 1,200. So then that person would then go to the bank and then cash that check. So then the money would get debited off your account and then that person would get money. So it's as good as cash. So if he paid it by check, so it means it's cash. So money went out of us. We lost something. We lost cash. Remember, we had 40,000. Now it's starting to use it. To reduce it, you need to put it on the credit side. There you go. I think I'm gonna stop here, guys. Uh, I'm gonna continue with these examples and bring you more examples as well. I think I'm gonna stop here. I'm really tired now. Okay, but I know it's correct. Actually, I forgot to check the solution. Your assets went up. Sorry, your bank lost money, decreased by 1,200, and your assets, which is your tools and so on, they went up because you bought a new ladder. So I think I'm gonna stop here. And yeah, we're gonna continue with more examples. I'm gonna try and also give you more examples so that you fully understand this. But all the time when you get a question, see if what is the transaction. Like for instance, already here you can see they borrowed money, so they owe someone money here. So you can tell already there's a liability, and liabilities they go up on the credit. So you would come and put it here. And then also this was transferred to the bank account. You see, our bank account also received money. So you can see that, okay, our bank account is an asset, so this will also go up. But I'm gonna stop here for now. I'm gonna do more examples on equity, and then until you really fully grasp it. Thank you so much.